Unrivaled Nation. Today I'm going to share an exclusive video for you about my personal journey because a lot of folks have asked, like, hey Daniel, what's your background? Can you share your story? So that's what this video is all about. It's sharing a little bit more about my personal journey. This is for your own entertainment. You can completely ignore this video. I'm not sure if how this could impact your journey, but because many of you have asked, I'm going to share it. So I was born and raised in Southern California. I still live in Southern California today. I do have family on the East Coast, which I would visit on a regular basis. Particularly growing up, I pretty much lived during the summer months on like this farm in Connecticut that I absolutely loved. And so that was sort of my childhood. In middle school and high school, I started realizing I often didn't necessarily always fit in with crowds, that I'd feel very comfortable being by myself. I'd feel comfortable being in a crowd or conversing, but I sort of was indifferent, if I'm sitting by myself or I'm sitting with a group of people. And that was sort of eye-opening to me that, like I don't have to be with everyone. I don't have to be with a group of people. And it made me start thinking, I wonder if this is something that's about me, like this is who I am. Like I had no problem sitting, like I went to a big high school with, several thousand people. I had no problem sitting and eating lunch by myself. I did have friends and things like that I could eat lunch with, but it was just one of those things where it's like, today I feel like sitting and reading or something like that. And what had a really early influence on these formative years was reading this book, which is Buffett, The Making of an American Capitalist by Roger Lowenstein. This is the first book I read about Warren Buffett. And that was really eye-opening for me because at this time when I was in middle school and high school, where I was starting to sort of say, I don't always want to be with a crowd, seeing a guy that could sort of march to his own drum, live in the middle of Nebraska, which reminded me sort of like, hey, it's sort of like the country life or the farm life that I was sort of getting exposure to in Connecticut. That is, farm's very liberal here. It's really just rural life. I wasn't milking any cows or anything like that. There were cows right next door, though, that woke me up every morning, but no, I wasn't milking any cows. So reading that here it is, Warren Buffett could be this really immensely successful guy, and he's not a jerk. And he can actually do it about the right way. You don't have to be the Gordon Gekko type. You don't have to be a competitive asshole or a jock or whatever you want to call it to be the winner in life. You could be the nice guy and still be wealthy over time. And it sort of fit what was turning into my temperament of saying, hey, just marching to my own beat. Whether do I want to sit by myself? Do I want to sit with a crowd? So that book was really sort of transformed me. And it was one of the things that my dad passed along to me when I was in middle school and high school. And my dad was very interested. He was a doctor, and he was interested in sort of understanding the investment landscape, understanding what drives it. And with a doctor's background, he didn't really have a lot of experience. Do I buy, what's cheap, what's not? He could understand the psychology of the market, but he didn't have enough background to understand what's actually driving a stock, what's the risk reward. And it was, for him, that psychology worked out for him, but it could bite you in the butt if you don't understand the risks of a business. If you can't understand, like, for example, you can understand the psychology of a stock with, let's say you're looking at a bank and you see it dropping and you're like, okay, I can tell there's a lot of fear now. Now's the time I should be buying. But if you don't have the background to know, what, this bank's actually filled with crappy loans, you can blow up. And so that was sort of my dad's, I'm sort of doing an abbreviated version of my dad's own financial journey. But he was the one that sort of got me hooked to investing in the first place. And from that, I also had an uncle who's also involved in the investment field, where he's sort of a trader. And between my dad and my uncle, I started reading annual reports, and started going to investor meetings at a very young age. There's a meeting in 2003. There's Charlie Munger, who's the partner to Warren Buffett, used to do meetings with a company called Wesco. Now it's with the Daily Journal. And I used to go to those meetings, the Wesco financial meetings, where I could see Charlie Munger. And so there's actually like a transcript from like a 2002 or 2003 meeting, where there's like this young guy asking from Whitney Tilson's notes of this Charlie Munger meeting at Wesco, where a young shareholder asks, like, Charlie Munger, how do you get rich? And that was my question for him. I stood up and I said, look, I'm a big fan, but what are your thoughts here? Obviously, I was very, very green, asking this billionaire, like, hey, what are your thoughts? Help a young guy out, help a teenager out. And his thoughts were, look, you don't need to have it fast. You don't need to have a lot of things you might think you need. So if you can make sure you actually do a check of what are the things you really need in life. Like there's a lot of societal, where am I on the hierarchy signaling that people do? Like, hey, do I drive a nice car? That's a nice signaling. Do I wear a nice watch? That sort of signaling. So that you don't need in life. That's Charlie Munger, and he made a point of driving a POS car for many, many years, even though he was wealthy many times over. And hearing about his background, and hearing this advice of like, hey, you don't need these things. What you do need to do is try to get a little smarter every day. Try to learn about a little bit something every day. And if you decide to get into the field, the water's fine. It'll be comfortable. Like you'll if you work at it, you could do fine. And so that was, that really further got me excited. And so I proceeded over the coming years. I went to UCLA. I was like, hey, I know I want to go into finance. During my senior year in high school, I took econ. Because I was in marching band, I couldn't, which was an AM class, I couldn't fit economics, the AP economics class, and so I took AP economics at lunchtime, where I would look at the notes that the teacher left on the board, and that's how I taught myself economics, is like reading his notes, and then that sort of put it together. And I was like, man, I love this stuff. This is the class that got me the most. This of the high school classes, I was like, economics just is so much more fun. So it was sort of adding fuel to the fire. Like, hey, fire, this is what I want to do. And so I went to UCLA just because I, once again, born and raised in Southern California. And I was like, look, this is a beautiful school. I think it's the best of the UCs. And so I was fortunate enough to get in. And also one of my heroes in life, who also, I would say the two really early heroes, I would put Buffett and Munger as one, because they have a lot of shared Midwestern values. The other, I would say, is John Wooden. And his key aspects in his books. His book is right over here. Which, this book was just dynamite, a lifetime of observations and reflections on and off the court. That book was just dynamite for me. Had a huge impact because the main takeaway from John Wooden, he was a basketball coach for UCLA Bruins, won many championships, won a disproportionate share of championships. But the reason why this book was so influential for me was that it was all about process. It was all about, hey, let's make sure you put on your socks smoothly every day. And that was one of the first things he taught his players. He taught Kareem Abdul-Jabbar how to put on his socks correctly. And Bill Walton, hey, I'm going to teach you how to put on your socks. And they're like, what? We're good we're good, basketball players. You don't need to teach us how to put on our socks. He's, no. We start from the basics. It's all about building up a process. And so I really enjoyed that because it's process focused. It's not outcome focused. Because if you focus on the process and you nail that down and you do the best that you can, you focus on yourself, then you can't control what your competition does. You can't control, what a teacher does. You can't control a lot of the variables. So focus on what you can control, and that is yourself. And the definition of success, this is from John Wooden, is not some external, vote. It is the definition of success is this peace that comes from knowing that you've done the best that you can. And that really resonated with me, and that's like, oh man, so that starts flowing through me through everything. Like, oh, that flows through investing. Let's have this process. Let's finding companies. But then the challenge is like, well, how do I find a process? Like, what's the right way to look at stocks? What's the right way to think about these things? And believe me, it's been a journey, and it will continue to be a journey for years ahead. Like I not only read Jim Cramer's books, I read the books about Jim Cramer where people wrote unfavorably about him. So here's one book about working with him when he was running his hedge fund and how he was on a bunch of, opiates. And, Joel Greenblatt's book, which is Dynamite, about, special situations, that also, opened my eyes. And here's one in Gerald Loeb thinking about trends and price action, and Michael Steinhardt, one of the first major hedge fund managers, made me think about his game. So each of these books, it was sort of about well, how did these guys do it? Do I try to emulate it? And so that was sort of my high school, college years, UCLA, figuring this out. I knew I was going to go into finance, so I did econ, graduated a year early. While I was at UCLA, I did two personally valuable internships. One where I worked it was a wealth management for, it wasn't JP Morgan, it was Merrill Lynch. And so I did that for a summer, and I also interned at a private equity shop for about a year. And it's a small private equity shop, but it's I'm still friends with one of the founders, and he really opened my eyes to investing, how to think about investments. It was an incredible experience, and how to think, this was my initial exposure to private equity firms. How do they think about investments? I worked with him on helping to try to find methadone clinics, which help people with the opioid crisis in terms of getting them off illegal substances, and getting back to a normal life, and talk about a very sticky business. But what were the economics of that, and how do you get just incredible returns from that? So that partner at that private equity firm, I'm still good friends with, and he's been an advisor and friend since. So that was while I was at UCLA. I'm getting exposure from all sorts of different things. I did get a little exposure. I did an internship at some, a small hedge fund that later shuttered. That was all about technical trading. And then after that, during my senior year, my last year at UCLA, a guy named Stanley Gold, who helped advise Roy Disney's assets, he came and spoke at UCLA, and he said, look, if you're going to go in the investment field, you should learn about distressed debt. And I was like, I don't know anything about distressed debt. Why are you recommending this? And he was like, the reason why I recommend this is because we are in the middle of a housing bubble, and within the next few years, the housing bubble is going to pop. And this perfectly aligned with the timing of the housing crisis and my graduation. And I'm really fortunate that I took his advice, because I subsequently, I interviewed with dozens of firms, but honestly, my top choice was to follow his advice and go into a distressed debt firm. And so I ended up working at a distressed investment bank, so a bank that focused on trading distressed debt. So that taught me all about bankruptcies, restructurings, the difference between a good bankruptcy and a bad bankruptcy. There's all types. One is because the company is just not doing too well, and the other is you just have too much debt, and that just needs to be handled differently. In some cases you could just have, anywho, that we'll save that for another video. In some cases it's like a structurally declining business. In other cases it's just you had a hiccup and you triggered a breach in your debt, in which case it needs to get restructured. And those are just beautiful situations when they happen, because if you're able to buy the distressed equity in those situations, you can get a great return. Um, and so during this time, so I went and joined a distressed debt investment bank, and I worked first as an investment banker. And honestly, I hated that lifestyle. You're working 7 days a week. They tell you pretty much like, look, if you're not here on Saturday, don't show up on Monday, sort of thing. Um, and the hours were tough. I gained a lot of weight, and it just wasn't a ton of fun. But I did get to sort of see how the sausage was made, because as an investment banker, a lot of what you're doing is pitching your product to other investors. You're raising money for a firm, and oftentimes, who needs an investment bank? The firms that need an investment bank generally are crappier companies that need to raise debt, or it's some sort of company that's like really stable, but they're borrowing lots and lots of money, so they need to spin it in a favorable way for raising debt. Um, and so, that's valuable for me to see how the sausage was made, and I think you could sort of see that in some of the videos I've done, where it's like, oh, okay, I see how the banker's trying to put lipstick on this, because I once was one of those bankers. Um, and it's interesting from that experience. It was really eye opening. The difference between how Buffett, let's say, does things. This is one biography. Snowball's even better. But going back to the banking stuff, um, the way Buffett invests is like, if he sees one thing that's a deal breaker for him, it's just over. Like, it could be a 10-second process for looking at an investment. He's like, oh, okay, done, move on. If I'm going to lose money, done, move on. Whereas I'd say a lot of the investment landscape is, you're like, well, if this bond is yielding 7% and I think it's a garbage company, maybe I'll buy it at an 8% yield. And that's how I'd say a lot of the industry works. Like, a lot of the industry works is like, well, what's the right price for this garbage? Whereas Buffett's just like, I'm not playing that game. Homie, don't play that. So that was interesting to see, like, to see the rationalizations that go into the investment game, as well as the lipstick that goes onto these prospectus, these presentations. I was fortunate enough, while I was at the investment bank, I actually pitched an idea to one of the founders of the investment bank, of an oil and gas company. I didn't really know what I was doing, but I thought it looked cheap. It subsequently, an activist came on board, and the stock went up like 80% in just a few months. So short term, I looked smart. Long term, like, looking back on it, it's like, whoa, what was I talking about looking at an oil and gas company? But we're so much dependent on the price of oil. But the founder was like, okay, I made some money off your pick. Why don't you come on the sales and trading side? We also have a hedge fund, and you can also consult for that. And so I went from the investment banking side to the sales and trading side, which was, an interesting experience, because now I'm actively seeing the bonds, distressed bonds go through the desk. I get to analyze them. I wasn't pitching, distressed debt. I wasn't like calling firms or anything like that at first. It was all about, let's analyze these bonds and give it to the sales force on what we think, the upside downside could be. Like, hey, this bond has a 13% yield. Here are the risks. Here's why it's trading down. Here are the different types of bonds in this capital structure. So that was a really interesting experience, just to see, and to get this exposure that most of these situations where you're getting sort of high yield bonds, it's generally crappier companies that borrowed a lot of money, or sometimes it's some sort of cyclical issue or some sort of financial business that just inherently borrows a lot of money. A lot of financial stocks, it's the nature of it is that they, like banks and financial institutions, it's all about borrowing a lot of debt, and leveraging your small amount of equity to get big returns. So that was, it was a heck of an interesting exposure. It was great ride. It was also great financially for me during that time period. I bought my first stock that turned into a 5-bagger within a year. If I had been smart enough, it would have turned into a 50-bagger, if I had been smart enough to hold on to it. But at that time, I was just like, oh my gosh, a 5-bagger. The people on the trading desk, and I put like a third of my wealth into this, and so like it was just a great setup. The stock had dropped 70% in a day, and the reason why it dropped was completely disconnected from the reality. And this was in the middle of panic. This was in November 2008, when people were just panicking left and right about things, and it dropped 70% really on fake headlines, which sort of blew me away. So that was fantastic risk reward, fantastic return, but it did sort of lock me into a certain mindset of like, hey, I need to find really cheap stocks because this really works. And I found a bunch of other things that turned into multi-baggers as well during that environment. So I was blessed to have gone through that environment where I had several investments that did turn into multi-baggers. But it did sort of lock my mindset into, let's just find cheap things and buy things at, let's say, a low multiple of free cash flow, and it'll work out over time. That was a locked in mindset, and it was unfortunate that I stayed at that mindset for so long. And I'll get into that in a little bit. But after a few years at the investment bank, the sales and trading side on the distressed debt, the working partly for their hedge fund, there was another hedge fund, a multi-billion-dollar hedge fund in Los Angeles, that was long short stocks, and I was like, okay, you know what? Let me throw some stock pitches their way and see if they're interested. So they're like, hey, we're definitely interested. So I got brought on board, and I just really didn't, I'd say my mentality just didn't fit well with their approach, and like a lot of it comes down, like I didn't know it at the time, but what was starting to formulate over time, because this is a journey where I'm figuring pieces out, was that what really drives long-term returns is growth. Growth is the biggest variable to what drives returns. So then the next question is, well, what drives growth? And that's where I keep going, that if you have a company with an unrivaled value proposition tapping into a large potential market, you are going to have lots of potential growth. And so that's where I was like, okay, that's what you need to focus on. But I wasn't able to put that to words at that time while I was working for this hedge fund. And so they had a very traditional, if the stock's at 30 times, maybe it's a short. If the stock's at 10 times, it's a buy, regardless of the business model. And that honestly did terribly. And it sort of put me in a rough spot being at that hedge fund, because the founder, keep in mind, he was worth hundreds of millions of dollars, making tens of millions of dollars a year. He would short a stock and then say, Daniel, give me the reason why I should short this. Now, I automatically, that puts me in a tough position, but he was short Netflix. He was short Precision Castparts. He was also short Lubrizol. Netflix, many people know, worked out very well. But Precision Castparts and Lubrizol, he shorted both of those. And I was like, yeah, I know the valuation is rich, but these companies seem like they have a strong value. Like, I couldn't quite see it, but I was just like, but it seems like they're going to grow over time. So even though they're rich, I think it's probably worth it. And so then he asked me, I remember this like word for word, he's like, Daniel, if I put a gun to your head, are you saying buy or short this? And I'm like, and for me, this is a formative experience, staring at a guy that's worth hundreds of millions of dollars, that's already shorted tens of millions of dollars in these names. And I look at him and I say, I would buy them. And so, this goes back to high school, being comfortable sort of sitting by yourself, figuring out what's right by you, calling it as you see it. And, in both of those cases, he was like, okay. And he did trim the shorts significantly. And it was a good thing, because Buffett actually bought both of those companies outright for Berkshire Hathaway. So it's sort of a funny story there. But that, being in an environment that it's inherently short the great companies, that's obviously not going to work long term. It did, look, being short expensive and long cheap worked for a long time. But we, in the last decade or two, have entered a period where that's starting to get a little unhinged. I suspect that reverts at some point, but nevertheless, So that was my experience at the hedge fund where I did that for a few years. That was also sort of a lucrative experience, and it also was an experience where it helped me start putting these pieces together. And so then I said, all right, I've had enough of I've seen how the sausage was made. I've seen how that, hedge funds work with major banks. I've seen how the IPO process is a rigged system firsthand. I saw how, the hedge funds that do the business get the share allocation. So I was like, screw it, I'm going to try to launch my own thing. Let's just see what happens. The challenge at this point was I still was locked into the mindset that I saw from the financial crisis of, hey, if you buy something cheap, you can get a great return. And that is by and large is true. But in a stock market that over a decade becomes cheap to fair to not cheap and up, it becomes increasingly difficult just to buy cheap stuff because the cheap stuff becomes inherently worse and worse quality. Within my first year of launching my own registered investment advisory firm, I did buy a situation of a spin-off, and that's based on Joel Greenblatt's book on special situations, where it was a stock, it was spun off, and it was trading at 8 times. And I was like, this is great. I'm going to make this 10% of my portfolio or 12% of my portfolio. And it doubled in the next year. And it was a company called Stars. And they were a pay TV channel. And it's great. Bought it 8 times, sell it like 15 times, and they buy back, let's say 10% of their stock during the year. Great. But during that experience, I learned, what? Netflix, yeah, it looked a lot more expensive, but they were growing a lot faster, whereas Stars wasn't. And you know what? Amazon Prime, they were growing their offerings a lot, so maybe I should have looked at Amazon. And just looking back, several years later, after my first year when I launched my registered investment advisory business, my RIA, is that even though I made 100% on Stars, it would have been better off. I would have been better off buying Netflix, which appeared much more expensive, way more, even on an optimized margin basis like I do with most companies. Even on an optimized margin basis, it would have been a higher multiple. Oops. It would have been a higher multiple, but, sorry, the computer went off for a second. But I would have been way better off owning, Netflix or Amazon because it was growing so much faster. So this really started waking me up over time. Like, man, I need to be focused on growth. Like, that's where the future is. So that it's taken years for me to develop this process, and thankfully I read Chris Mayer's 100 Baggers. That was a really helpful book where he's like, oh man, that's the way to do it. Is you find these companies that have the potential to be 100 baggers, can go up 100x. And even if you don't find them on their first 10x, what's the secret to finding a 100 bagger? Find something that's already gone up 10x. And that's the reality is you look at many of my top holdings, many of them fit that profile. They've already gone up 5x, 10x. Where it's like, hey, do you have the potential to go up another x, another few x? And So I had my registered investment advisory business. It was sort of a challenging position just to constantly look for cheap stocks, buy Oracle. Oracle doesn't go anywhere. And so I was sort of just sitting around like buying these crappy companies that would go, nowhere for a few years because they're cheap stocks. Maybe I'd get a little bit of return while the stock market's going straight up. So I said, what, I need to revisit. I need to start rethinking what I'm going to do. What's my approach to life in general? Like, is it just buying things on the cheap, or do I need to consider something else? And that's when I actually started realizing, what, and this is from talking with a mentor, and Peter Kaufman, who put together Poor Charlie's Almanac. He was the one who sort of pointed me to the idea of finding businesses that are have a unrivaled value proposition. When you have an unrivaled value proposition, it gives you the right to win. And so he, opened my eyes, and I said, oh man, that's the approach. That fits with all the data I've seen. Find unrivaled value, and even if you're paying a fair valuation for it, maybe even you pay up for it, long term, that's a winning approach. And I realized not only do I want to do that with investing, but I want to do that in all of my life. Everything I want to do, I want to approach it with an unrivaled angle. And that's also part of what I'm trying to do with YouTube is like I noticed that a lot of YouTube videos, honestly, I think are pretty hypey and low quality in terms of their analysis. And so that's where I'm trying to like, hey, maybe this could be unrivaled for a lot of people if I do these videos. But before getting to that, so I realized that's what I want to do. I'd love to go work for a company that seems like it's unrivaled, that's growing real quickly. And sure enough, at this time, a high school acquaintance was like, hey, Daniel, I hear you're in finance. I run an app on the Shopify store, the Shopify platform. I don't have anyone running finance. Would you be interested? And I said, yeah, sure. What's your value proposition? What's your app? And the app was in charge of subscription services, and it was growing very quickly. And so I said to myself, hey, this could be great. This could be a great experience to help them out. And so from that, I started off just, let me just help a couple hours here because I'm doing my investment too. Hey, this is pretty interesting. I want to align myself with unrivaled value propositions. And so I did that, and I became, effectively their head of finance at this company where at first they had a few $1,000,000 in revenue. I recognized they had an unrivaled value proposition. They were growing quickly. They were taking market share. And, from the time, a few years later, they had 40 million, and I helped them raise, tens of millions of dollars at a multi-$100 million valuation. So that was a really great experience for me to go through of helping this company sort of transform their balance sheet, helping the founders get a nice liquidity or a nice payday, me get a front row seat in sort of how successful startups work, how the capital raising process works from the other side, from the company itself. Going through the venture process was really neat. What are the types of metrics they want to hear? What are they thinking about? And the downside to it was that I realized that once you sort of bring on a professional venture capital firm and they want a board seat and they just wrote you a $50 million check, they're going to have higher expectations. And I really I had a great experience, but I had never brought a company public before. I had never helped take a company to that next stage with audited financials and going to GAAP financials. And so I was like, you know what, this I don't think this is going to be part of my journey going forward. And so they brought on someone who had done that, who had, prepared a company for publicly, available financials, effectively a public company CFO. And so I was like, all right, so what's next? And that's what brought me to here, where I was like, you know what? I think it would be really cool to start making these investment videos. I started playing, put my toes in the water with some early, really cruddier versions of the video. But it seemed like I got positive feedback. And honestly, this goes back to high school where I enjoyed learning about companies. I enjoyed, learning about finance. And by sharing this enthusiasm with others, I remember for years I would share my every week I'd have dinner with my parents, and I would say, hey, on Friday night, and I would say, hey, this past week I looked at these companies and I think they're really cool, and but they trade at this valuation, yada yada yada, and my parents would sort of look at me like with a blank stare in their face, like, Daniel, why are you telling us this? And so it's sort of funny to me, like, hey, I finally got an audience that's actually interested. I think my parents do check in from time to time on YouTube. So that's sort of the story here. That's sort of my journey up until now. And honestly, my focus now is let's lean into this journey. My goal is that create exclusive content, create content on YouTube that's educational for people, where I'm learning about companies, they're learning about companies, and then for the extra material, for the stuff, the potential multi-baggers each month, my own personal investment updates, bring that to your attention. But I'm leaning into this. I think this is going to be a really fun ride, and I'm excited about continuing with this journey for the months and years ahead. And I'm grateful to be able to share this journey with you. And I apologize for the long rambling video, but a lot of you have asked what's sort of my personal background, and that's it. So that's the story.